Jeff, how are you recommending clients play this one?
You know, the markets seem to be pricing in just as high of a probability of a delay in the imposition of these tariffs in July as they are of the Fed cutting rates in July. I think, therefore, the risk is that the issues that divided these two sides 6 weeks ago are still in place today, and maybe we don't get a deal. I'm not saying that's the base case, but it's certainly a risk to the market's hypothesis. And in that case, you've got to look to more defensive sectors, those that have lagged this year, like the healthcare sector.
Jurrien, what about you?
Yeah, I mean, I think this is an area where maybe expectations need to be lowered a little bit. I do think there's probably going to be some sort of ceasefire, if you will, and whether that includes not implementing, tariffs that were threatened for a while negotiations take place. I think that's very plausible. And in the meantime, of course, the Fed is poised to ease, maybe not by the 50 in July that the market was sort of whispering around, but certainly, 25 in July and maybe another 25 in September. So I do think the Fed will likely deliver on that front. But, I keep going back to this example of Brexit, which, of course, the referendum there started 3 years ago, and nothing has happened. And I think this is also a very slow-moving process, and whether there's a light at the end of the tunnel or not remains to be seen. But in that environment, valuations get derated because that is the price of uncertainty, and I do think that that's pretty likely for the markets going forward, even if earnings are up. But I think it's a valuation story here.
So what? China trade just stays in the background, but what if we get even 10% on the other 300 billion, Jurrien? Does that move the needle at all?
I think incrementally it does. Profit margins for the S&P 500 peaked at 12% last year. They're down a little bit. Earnings growth has gone from 22% last year to probably 4% this year. So one of the changes in the story this year versus last year, when this whole tariff, stuff started to happen, is that the U.S. has actually joined the rest of the world in slowing down. That was not the case a year ago. So we are in a more, not precarious situation, but certainly the global economy has now slowed in a more synchronized way, and that, of course, is what has put the Fed and the ECB on notice here. So we will get some relief, but I think this headwind of not getting any direct, clear resolution is going to continue to weigh on valuations.
I mean, Jeff, you guys have been cautious for a while now, at least over the past few months. Are you surprised then that the Dow is set to have its best June, I can't keep track, since 1938, I think?
I think the market is putting way too much confidence that the Fed can just paper over all of these potential shocks to the system, not just from trade, but other issues, geopolitical shocks, of course, Brexit, so many other issues out there affecting a global economy, which Jurrien points out is slowing. I think the idea that the Fed can simply cut rates and make that go away flies in the face of history. For example, September of 07, the Fed cut rates. That didn't stop the 08 recession. In January of 01, they began to cut rates. That didn't stop the 01 recession either. So I think the market way too much confidence in the Fed's ability to wave its magic wand, and I think it might be disappointed in the second half of the year.
So are you saying break out the recession playbook? And if so, what does that look like?
Yeah, I think we need to recognize that there's a heightened risk of recession here. I think the recession playbook looks a bit more defensive. I think it looks you're moving out of high yield into cash. I think you look to defensive sectors of the stock market. Again, healthcare has been a miserable performer this year, but look what it did in the fourth quarter of last year. It really outperformed, was the best performing sector as stocks fell pretty sharply. So a more of a defensive orientation to portfolios for the second half we think makes some sense.